Today we're going to consider one of the halfway houses between monopoly and competition. It's called monopolistic competition. Way to think about monopolistic competition is it combines some of the ingredients of monopoly and competition. And remember, when you combine these agreements, we're considering a model, and we want to apply that model to situations which are close to these conditions. Ultimately, it depends on how well the model works, whether the model is useful or not. So on the left, we've listed the properties of monopoly. We've already considered, remember there's one firm, and that firm faces a downward sloping demand curve. On the right, we see the competition. We've defined that as a situation where there's many firms. They face a flat demand curve, and there's free entry and exit to this industry over time. And remember, by flat demand curve, we mean that the competitive firm is a price taker. Can't influence the price, just has to take the price in the market as given. Now, there's a rationale for this assumption with monopolistic competition, and that rationale is product differentiation. Some products are slightly different than other products, so they might look the same. So for example, there's different types of sodas, there's Coke and Pepsi, there's different types of running shoes, there's in fact different types of gasoline. There's all sorts of product differentiation, which means the product is this kind of the same product, but it just differs a little bit. And the manufacturers are sometimes want to appeal to people's tastes. Some people like one kind of soda versus another, one kind of running shoe versus another. There's various reasons for this kind of product differentiation. Sometimes product differentiation can occur just because of location. For example, a gas station just down the street selling the same kind of gasoline is slightly different product than the gasoline station 2 miles away. They're located in different areas. If you're close to one gas station, you might want to go there. The product to you is somewhat different. It's closer than the gas station further away. So that's the case where even the products are the same, but there's some differentiation based on where the gasoline station is located. So we want to build a model of this situation. And I'd say one of the nice things, maybe even the best thing about the monopolistic competition model is we don't even have to introduce any new diagrams. It's basically the same kind of diagrams that we've already introduced when we studied monopoly. And so let's just take a look at that model, for example, because it's going to be the same. So we're going to have our usual axes, the quantity produced. We're going to represent price and marginal cost with dollars on the vertical axis. So we can have a marginal cost curve. We can have a average total cost curve right there. We can represent a demand curve for them right there and a marginal revenue curve right there. This is going to be the picture for a monopolistically competitive firm. As for any firm, we're going to assume it maximizes profits, which will mean, as we've argued in the past, that marginal cost and marginal revenue will be equal. The firm will produce that amount. And then to get the price, we go up and get that price off of that axis. To get average total cost, we go there. And in this case, this firm is running a loss because average total cost is greater than the price, and the loss is that amount right there. So that's the quantity and the price. And this is the picture that we're going to use to study a monopolistically competitive firm. You might say, hey, that looks exactly like the picture for a monopolist. Well, it is exactly the same for a monopolist. We're going to interpret it slightly differently to get the assumption of a monopolistically competitive firm. And so to do that, just think about the demand curve sloping down. And we're now going to explain how we interpret this picture differently than in the case of a monopoly to get the monopolistic competition results. And so there's a little bit of a trick there called the trick behind the monopolistic competition diagram, because as I've drawn it, it looks just the same as a monopolist. The trick is this idea of entry and exit. And that is that as other firms enter and exit the industry, the demand curve will shift and the marginal revenue curve will shift as well. So you could think of this, to make this diagram work, As you see other firms entering and exit the industry, you shift the demand curve, and thus the marginal revenue curve of the typical firm. And we want to make these curves shift not just arbitrarily, but based on the incentives that firms have in the industry. In particular, if there's economic profits in this monopolistic competitive industry, so the typical firm is earning profits, positive profits, then we're going to assume that firms enter the industry and that shifts the demand curve in for the other firms that are already there. It shifts the demand curve in. So the demand curves are going to shift when we do this. And the same thing true if there's losses, it goes in the opposite direction. If there's economic losses, as we showed in that sketch, that's negative profits. In this case, firms want to get out of this industry, want to either go somewhere else or take another job, but that's going to make the demand curve shift out as other firms exit. And so that curve we just drew, the curve we just sketched, is the curve for a typical monopolistic competitive firm. But unlike a monopoly, it's operating in an industry where other firms can come in and join it, or other firms can leave. And that coming in or leaving depends on whether the typical firm in the industry is either earning profits or not. So with this idea in mind, let's look at the diagrams and with the colors so they're easy to see. And in this picture, there's two situations for a monopolistic competitive firm. On the left is where the firm is making profit. We're going to call it short-run profit because firms have not entered the industry yet to bid away that profit. And on the right, we're going to have a situation where there's losses. We're going to call that short-run loss. Short-run because firms have not exited the industry because of the losses. So look carefully at the left, for example, first. So downward sloping demand curve for the monopolist, marginal revenue curve below that. We see the upward sloping marginal cost cutting through the average total cost curve at its bottom point. We know for this firm that the maximizing profit position is where marginal revenue equals marginal cost. We get the price off the demand curve and the average total cost off the average total cost curve. There is profits in this case. Economic profits are positive as shown by the green shaded area. Over on the right, same kind of demand, marginal revenue, marginal cost is moving up. But in this case, the average total cost curve at the maximizing position for the firm is above the demand curve. So that means when you look at the quantity produced where marginal revenue equals marginal cost, and you calculate the price at that quantity out the red line, it's lower than average total cost. And so that's really the reason for the loss. Now, in both these cases, this is a monopolistic competitive firm. And you want to ask yourself, why is the demand curve sloping down? I can understand why the demand curve slopes down for a monopoly. In order to sell more product, it has to charge a lower price. Well, the same is true for a monopolistic competitive firm. It's selling a somewhat differentiated product compared to other firms in this monopolistic competitive industry. So if it charges more for its running shoes, which have a certain design or a certain logo, compared to another firm, which has running shoes that are almost the same, but a slightly different logo, it's going to sell less. And the higher the price goes at one firm compared to another, the lower the quantity demanded. So even though it's not a monopoly, it's actually able to charge different prices, and the higher price it charges, the lower the quantity demanded will be, because consumers will go buy another product. Okay, so that's the reason for the downward sloping, is that product differentiation. There can be a lot of firms in the industry, the products are slightly different. It's not a monopoly, but it still has this downward sloping demand curve. So that's the rationale for the picture. And of course, in this situation, it's possible in principle for the short run to be profit or the short run to be loss. Now, let's consider what happens in the long run, because this is where the diagram really gets interesting. What we're going to argue, and maybe first focus on the left-hand side, what we're going to argue is that in a situation where the firm is making positive economic profits, there's going to be an incentive for other firms to come into the industry to try to earn some of those profits too. And when other firms come into this industry, they're going to be taking away some of the business of the firms already in the industry. What that means in this picture is we want to shift the demand curve for the typically monopolistic competitive firm on the left down and offer to the left. We want to shift it in the direction of a smaller quantity because this firm is now competing with more firms. Those firms are now in the industry with it. And so the amount that consumers are going to buy is going to be less. It's going to be shifted over to the left and gone to other firms. And so the dynamics of this is going to be that demand curve is going to shift over to the left. And if we jump to the next picture, you can see what eventually is going to happen. In the long run, the demand curve is going to have shifted until there's no more economic profits. And in this case, the diagram is drawn exactly that way. It's the same marginal cost, average total cost curves, but in this case, compared to the situation where the firm was earning profits, the demand curve has shifted, so it's now actually exactly tangent with the average total cost curve, and also in a situation where marginal revenue and marginal cost are equal at that same quantity. So this is drawn in a very particular way. So marginal cost equals marginal revenue generates a quantity in the picture, and that quantity right there generates a price and an average total cost, which are equal, so there's zero economic profits. And that's what has happened in the long run over time. We've got to this break-even point where profits are zero, the price equals average total cost. And if you compare that to where we just were before the long run came, right there over on the left, you can see what has happened. So the demand curve on the left is not tangent to the average total cost curve, but you can imagine shifting it over to the left a little bit until it's tangent and until the marginal revenue, marginal cost curve intersect at that point, and that'll be the long run. So what has happened here is we have, through the dynamics of this of entry into this industry, profits have been driven to zero, and that's a different from the monopolistic firm. Monopolistic competitive firm will have a different long run. Same kind of thing's going to happen for the firm running losses over on the right. In this case, what we would argue when this typical firm is earning losses is that other firms, at least other firms, will get out of this business because they're losing money too. And so as they leave the business, as other firms leave the business, this firm is going to experience an increase in demand for its product because some consumers who were previously buying at one of those other firms now come to this firm. So it's going to have a shift of its demand curve to the right because of those losses. Very important this is the trick here we're doing. This is the trick. This demand curve is moving, will move because of the losses. In this case, it moves to the right. And eventually, you're going to run to the long run, and the long run picture is exactly the same because you now shifted the demand curve to the right until it's just tangent with the average total cost curve. And it's got to be at that point because that's where economic profits are zero, where there's no incentive to exit or enter, where the marginal revenue, marginal costs generate a quantity such that the price equals average total cost, and that's your long-run equilibrium. So that's how the model works. The same diagram, but used in a very, I think, interesting, even beautiful way. Let's think of the conclusions we get from this. The long-run equilibrium of a monopolistic competitive industry has a situation where economic profits are driven to zero. That's kind of a nice thing, if you like. Competition drives profits to zero. But there's still some, if you like, inefficiencies associated. One is average total cost is not at a minimum. You remember the long-run competitive equilibrium has average total cost at a minimum because firms will compete and they take a price as given. So this is not at the minimum, and you can just go back and look at the picture to be sure of that. This is your long-run equilibrium, and the demand curve is tangent to the average total cost curve at that point. Since the demand curve is downward sloping, it's not at the bottom point of the average total cost curve. If it were a completely flat demand curve, you can imagine, it would be at the low point on the average total cost curve. So if for some reason it were flat at that point, you'd be at the bottom. But it's not flat, it's steep, so you're not at the bottom. And so that's, if you like, a disadvantage. You're not at minimum cost. You also note that the price is greater than marginal cost for this equilibrium. In terms of the picture, you have the price up here and the marginal cost down here. So price is greater than marginal cost. That's a condition of inefficiency, which we know from before. And of course that means there's still a deadweight loss in some sense. A deadweight loss, we can just go back to the picture and see quickly. A deadweight loss would be the fact that you have this difference between the marginal benefit and the marginal cost, and you've lost that amount of production. So the bottom line here are these disadvantages compared to a competitive industry. But what you have to realize is that it's not so simple to change things to avoid those disadvantages, because in fact the monopolistically competitive environment is generating something good for consumers. It's generating some variety of products. It's generating different kinds of running shoes. If people want them for different speed or different cushioning. It's generating different locations for gasoline, so some people don't have to drive so far. It's generating different kinds of soda and many different other things. So that variety, and one could argue it's too much variety, but it's generating a variety which it makes for a value to consumers compared to if every single good, every single shoe look exactly the same. So those disadvantages in some sense you can think of as the cost of variety. Thank you.